Stocks are still rallying on the back of that stronger data this morning, but it's just one data point, could be a head fake. One of my next guests is favoring large caps for that reason. The other is hanging her hat on productivity and getting more selective in her picks. Let's bring in Nancy Tengler of Laffer Tengler Investments and Guidestone Capital Management's Brandon Pizzurro. Nancy, I'll start with you. Welcome to you both. What do you make of this market?
I'm hoping that this is the correction that we've been waiting for and needed. We get one every 12 months. We get 5% pullbacks, kind of 2 to 3 a year. And we had been running, just kind of straight up. So it's good for the market to take a breather. I still think we're in a bull market, Kelly. I know that there's a lot of people that are now in the bear market camp, and that's what makes the market. But based on my experience and based on my analogy to the 1990s, there is so much, there are so many commonalities, not the least of which is this recent meltdown due to the yen carry trade. So I think you pick your spots. You use the volatility as your long-term investors, volatility is your friend. So we will be picking away at names that we've either trimmed, which we trimmed quite a bit in early July, or new names. And we are adding a new name this week.
So you still like, for instance, in Amazon, in Uber. Are those some places you're looking?
Yeah, I think you get an opportunity with Amazon because the earnings were disappointing, but to some, and the CapEx spending was disappointing. But revenue, operating income was up, margins were up. AWS, which is the engine, was up 19%. So we're going to use the weakness to add to holdings across our strategies where we hold it. And we think this is one of those opportunities that you get every kind of couple of years because the CapEx budget is up. And that tends, here's what I'll say. One man's increase in CapEx spending is another man's or another company's increase in revenue.
In revenue, exactly. And isn't it kind of fun to trace those dots, as long as it's all working and as long as the numbers all add up, which some say they don't. But I like, Nancy, how you make the point that the confusion we all feel. Pepsi and Procter & Gamble show this weakening with the consumer. Spotify and Uber, it's a very different story. Let me, on that note, Brandon, turn to you. Where would you be? Where are you putting capital to work?
Sure. Yeah. Thanks for having me. Certainly this whole pause that we got here was a big wake up call to the market. That AI momentum trade that's really taken a bit of a breath here. We like things that are over in the consumer staples space right now. We're not going all in on consumer staples, but there's some really strong names there, not necessarily to hide out, but just to add to your portfolio. Again, with just kind of this one-way trade, people are saying that markets don't always go up every single day for the next 2 years as they have for the prior 2 years, essentially. So it's a good time for people to reassess their portfolio. Like I said, we like some spaces in staples, even some medical technology. But both of those areas tend to be one place to kind of help offset some of this big cap tech growth that people have had.
All right, this gives me a chance to go on a little bit of a rant about consumer staples, and you're going to solve this. I look at the consumer staples like that, what is it, the IYK ETF, Brandon, or something to that effect? Yes. And granted, a lot of this is Coke, and that's kind of a unique story. Maybe we put that one aside. But a lot of the rest of these names, they're trading at all-time highs, even post-pandemic, when consumers, as we know, are looking and spending for things on sale, on value, right? We've heard from some individual staples names talk about how they need to do more on markdowns. And I don't know why you'd want to be exposed to companies that are going to face top-line pressure.
Sure. From a staple standpoint overall, if you look at some of these bigger conglomerates like a Unilever or General Mills in particular, they have all sorts of a wide array of product up and down kind of the value chain. So yes, consumers are certainly looking deeper in their pockets. They're looking for that next incremental dime to spend. As Americans, we love to spend our money as much as we can. And so that discretionary element, that's starting to fade away as people start to have less and less at their disposable income. But from a staples perspective, when you think about some of these, you need deodorant, right? You need the general things for your home health care, for personal care. Those sort of things are the things that people continue to spend money on. And what people will always spend money on, as we've seen from a General Mills perspective, is premium pet food. They have that Blue Buffalo brand for pet food. That's something that people just will not give up. They care for their pets, and we've seen that.
No, when I saw that one in there, I said, okay, I know this is going to be a pet play, but putting the pets, everyone's like, I'll sacrifice my meal before I'll have my pet go down market. Nancy, can you kind of weave that into your outlook? What do you do with consumer staples? Are there names you like there, or would you be kind of steering clear?
Yeah, well, so we own Walmart, and that's kind of the poster child of our investing theme of old economy companies that have pivoted to all the new technologies. We sold Procter & Gamble just because I know it's hit an all-time high, but it's 30% behind the market over the last 5 years. So if you no longer have pricing pressure or pricing opportunity, then you are going to see a contraction in margins. full disclosure, we own Pepsi. It's been a difficult name. I used to start every day with a handful of Cheetos, Kelly, and they've got so. Oh yeah, and they've got. In fact, my colleagues call them Nancy Tenglers, but they've gotten so expensive. I gave them up. It's ridiculous. So I think there will be a comeuppance, and these companies are trading at 21, 24 times. And I'd rather own Microsoft, which is growing earnings at 16%, trading at 31 times, as opposed to single-digit earnings growth at an all-time high in the case of Procter & Gamble. So we're looking at other places. Power was another name I brought to the show that we've been adding to. We owned it. They had great earnings. It got clobbered. And so we're going to be buying more.